Hello friends, welcome back to Idiot's Guide. On this week's edition, we are going to focus on trailing stop loss. First, we will cover what is trailing stop loss, what are the common mistakes people make when they enter trailing stop loss, what are the different types of trailing stop loss we can enter, which is the best trailing stop loss strategy to capture most of the trend. Having said that, let's jump into the lesson. Before we get into the lesson, I would like to recommend that you watch the video from start to finish completely without skipping or missing any part, because it's going to be a short video and I'm going to give a lot of information. If you skip any part of the video, you might miss an important information. Okay, let's start the lesson. Okay, what is a trailing stop loss? Trailing stop loss is an order you enter immediately after entering into a trade to protect your profits or lock in your profits so that it doesn't turn into a losing trade. For example, if you buy a stock for $10 and if you put a trailing stop loss of 10%, if the stock moves to $11, your trailing stop will be $10. So if the stock turns around to come down, the price comes down to 10, it will exit you without any profit or loss. And let's say in the same scenario, the stock goes to $12 and your trailing stop loss would have gone to now $11. Now if the price drops to 11, it's going to exit you, but you do make a $1 profit in this trade because you bought this for $10, remember? That is what the concept is about as far as trailing stop loss is concerned. Now let's look at what are the different types of trailing stop loss. The first trailing stop loss, normally what people use is using a percentage. So if you buy a stock, let's say I have an Apple stock in front of me in this chart here, the current price is $497. Let's say you bought the stock at the close on Friday at $497.48. If you enter a 10% trailing stop loss, if the stock drops $49.74 from the current price, it's going to exit you out of the trade. And let's say the stock moves to $550, and then if it drops another $55, it's going to get you out. That's how the trailing stop loss works. It's going to trail the current stock price at 10% below the current price to lock in most of the profits or prevent or minimize the losses as applicable. The second type of trailing loss is called ATR, average to range. I normally prefer using average to range instead of using percentage, but there is no saying as one is good versus other. It's up to the individual's convenience and which one you are comfortable with. Let me show you what I mean by average to range. I'm going to add the indicator ATR, average to range. There you go. Let's say you bought Apple stock to illustrate a point. Let's say you bought it here on June 29th at $361.78. The price, the average to range on the day at the close was $10.70. So if you would have bought the stock close of this day, you would have entered a stop loss of $10.70 below the current price or below the purchase price. So your trailing stop loss is going to trail your order at $10.70 below the current price. So when the stock keeps going up, when it starts turning around here on July 23rd, the high is 388 and the low is 368. Your trailing stop is $10.70. So when the price dropped from 388 to 378 and change, you would have closed your position and would have locked in the profit from 361 to 378. You would have got about $16 and change gain in this trade. Basically, the trailing stop loss takes the emotion out of the equation so that we don't make any human errors when you get into trade. Anytime when you get into a trade, you should always decide two things. What is your entry? What is your exit when the trade doesn't go in your direction? and what is your exit when the trade goes in your direction, and what is the trade size. These are the 4 factors you have to always keep in mind when you get into any trade to be successful in the long term. Let's look at another type of trailing stop loss, that is using a moving average. Let me plot a moving average. I'm taking an exponential moving average here. Let's say you are a short-term trader. You are using a 50 period moving average in this example. The same Apple's daily chart. Let's say you enter the trade on April 24th. Once it crossed above the 50 period moving average at the close at 282.97. You keep checking the price moving average every day and adjust your trading stop loss once a day. And when you get on July 24th, if you have a trailing stop loss, it's almost close to getting a trailing stop loss, but still it has not hit it. But if you have been adjusting a trailing stop loss every day, you'll be in this trade even till today with a highly profitable trade. To show an example when it will take you out, let's go a little further back. Let's say you got into this trade on somewhere around October 2019 at 227, and you are adjusting your trailing stop loss every day, once a day, by looking at the simple or exponential 50 period moving average, whichever you are convenient with. If you look at it on February 22nd, the price dropped below the 50 period moving average. So you would have exited around some price range between 289 to 304 on the day, or the next day at the open at 300. You entered in this hypothetical example, you entered at 230 as using moving average as a trailing stop loss. You were able to ride the wave till 300, which is about 70 points gain over the course of 5 to 6 months from October to late February. Let's look at another type of trailing stop loss with no indicators on the chart. This is the same Apple daily chart. Without using any indicator, you can still use a trailing stop loss. Let's see how to do that. Let's say you entered the trade on, to give an example, let's say on June 1st, 2020 at 321 at the close. What you would do is you would use the previous swing low as a trailing stop loss. In this case, 313.28 would be your trailing stop loss, and you will follow the previous swing low as the price keeps moving up. Here the price keeps moving up. The next trailing stop loss would be 321.59. Then the price keeps going up. The next trailing stop loss would be at 332.18 or 332.01. Then the trailing stop loss, you keep raising your trailing stop loss as it makes a new swing low. So the next one will be 333.61 and so on. And until your trailing stop loss is hit, you'll keep on raising it based on previous swing low. So in this example, you'll be raising it all the way here. You will have entering your trailing stop loss at 375.97 when the stock goes to 390.90. So this day you would have raised the trailing stop loss to this price, which is 375.51. After a few days, the price drops below 375.51. The low of this day is 368.04. So it would have been taken out of the trade. If you had a trailing stop loss using the previous swing low of 375.40, it would have been taken out of the trade around 375 on this day. If we entered here, as we discussed, you were able to capture a major part of the move from here to here, and you got chopped out only on this day, and you got most of the profit locked. This is another way of entering trailing stop loss with no indicators on the chart. Now, how about we enter the trailing stop loss in a situation where the stock makes a parabolic move or an exponential move like this, what happened with Apple on Friday. Where do we enter a trailing stop loss? We definitely cannot enter here because it's a big trailing stop loss. The gap between 436 to 497, that's about 60 points trailing stop loss. You don't want to enter that. So how do you enter that? In this example, you will just enter a trailing stop loss just below the previous day's high or previous day's low. In this case, you could follow closely at previous day's high at 474, and if the price drops next day below 474, you could exit the trade. In that case, you will not be losing much of the gains. You'll be able to lock in most of your profits. Okay, let's summarize. In this video, we covered what is trailing stop loss, what are the different types of trailing stop loss, how not to use the trailing stop loss, what is the correct way to use the trailing stop loss, and what is the best trailing stop loss. Personally, there is no best trailing stop loss. Any trailing stop loss works as long as you follow it consistently and consider your position sizing based on the trailing stop loss. But personally, I would prefer ATR as a trailing stop loss. If you decide to use ATR as a trailing stop loss, you could use anywhere from 2 to 6 ATR as a trailing stop loss based on whether you are a short-term trader or a mid-term trader or a long-term trader. For a stock like Apple, a 2 ATR would be more than enough for a short-term trader or a swing trader. If you are a long-term trader, you could use something like 4 to 5 ATR because Apple's volatility is not that high. It consistently moves in one direction. This is not a stock like Tesla where you need to have a very high ATR to give enough room for the stock to breathe when it's moving in one direction. That concludes the lesson for this video. I hope you like this content. If you like this content, please like this video and subscribe to our channel. That will really motivate us to bring more free content like this one. Thanks for watching. Hope you have a great day.